For decades, you probably thought McDonald's made its billions by flipping burgers and selling fries. You'd be wrong. In 2023, McDonald's generated over $25 billion in revenue, but less than 10% of that came directly from selling Big Macs. The truth is, McDonald's is one of the largest real estate owners in the world, and its primary business isn't fast food at all. It's landlording. Most people assume McDonald's is a restaurant chain that happens to franchise, and on the surface, that assumption seems perfectly logical. A typical franchise model works like this. An entrepreneur, the franchisee, pays an initial fee to use a brand's name, its systems, and its intellectual property. Then, they pay ongoing royalties, usually a percentage of their sales, back to the franchisor. They might also contribute to a national advertising fund. The franchisee is responsible for finding a location, securing a lease, building out the store, hiring staff, and managing all day-to-day operations. They bear the operational risk, while the franchisor collects a relatively hands-off, high-margin revenue stream. This is how countless chains operate, from Subway to Domino's, from Anytime Fitness to Hilton Hotels. But McDonald's subverts this model entirely. While it does collect those initial fees and ongoing royalties, those are not its dominant revenue streams. The genius, the true financial engine of McDonald's, lies beneath the golden arches, literally. It's in the land and the buildings. Ray Kroc, the man who built McDonald's into a global empire, understood this from the very beginning. Or, more accurately, his first CEO, Harry J. Sonneborn, understood it. Sonneborn famously stated, "We are not in the hamburger business. We are in the real estate business." This wasn't just a clever turn of phrase. It was the foundational strategy that transformed a fledgling burger stand into a multi-billion-dollar global powerhouse. The golden arches of real estate are not just a catchy slogan. They represent McDonald's dominant revenue stream. When you look at McDonald's financials, you'll see a segment labeled franchised restaurants. In 2022, McDonald's total revenues were $23.18 billion. Of that, franchised restaurants contributed a staggering $14.13 billion, representing approximately 61% of the total. But here's the crucial distinction. This $14.13 billion isn't just royalties. It's primarily rent. McDonald's Corporation typically purchases the land and often constructs the building for new franchised restaurants. Then they lease that land and building back to the franchisee. Think about that for a moment. Most businesses lease from a landlord. McDonald's franchisees lease from McDonald's. This means that instead of just collecting a percentage of burger sales, McDonald's collects a stable, predictable, and often escalating rent payment. They act as the landlord, and the franchisee is their tenant. This model is incredibly powerful. McDonald's acquires prime real estate locations, often at strategic intersections or high-traffic areas, and then leases them to franchisees. These leases are typically long-term, with built-in rent increases, ensuring a growing revenue stream that is largely insulated from the volatile costs of food, labor, or even changing consumer tastes. The franchisee bears the operational burden, the risk of fluctuating commodity prices, and the challenge of managing staff. McDonald's, meanwhile, collects rent checks, often at a substantial markup over their own acquisition and development costs. In 2022, the operating margin for franchise restaurants was approximately 81.7%. Compare that to the operating margin for company-operated restaurants, which was a mere 16.6%. That massive difference, that 65-point spread, is the real estate model in action. It's the difference between being a landlord and being a restaurant operator. This isn't just about collecting rent, though. It's about control and leverage. McDonald's owns approximately 45% of the land and 70% of the buildings for its franchised restaurants globally. As of December 31, 2022, there were 40,275 McDonald's restaurants worldwide, and approximately 94.8% of them, or 38,169 locations, were franchised. This vast real estate portfolio makes McDonald's one of the largest single owners of real estate in the world, and it gives them immense power over their franchisees. If a franchisee isn't adhering to brand standards, if their sales are slipping, or if they're not investing in upgrades, McDonald's holds the ultimate trump card, the lease. It's a system designed for maximum stability and profitability for the franchisor, pushing the operational risk onto the individual business owner. Beyond the dominant real estate revenue, McDonald's also benefits from the more traditional elements of a franchise model: forming supporting pillars to its financial structure. Franchisees pay an initial franchise fee, which in the U.S. is typically $45,000. This one-time payment contributes to the initial revenue, but it's a drop in the bucket compared to the ongoing streams. Then there are the ongoing royalties, often referred to as a service fee. This is typically 4% of gross sales, paid monthly. And of course, franchisees contribute to advertising funds, usually another 4% to 5% of gross sales, which fuels McDonald's massive global marketing campaigns. These fees, while substantial, are secondary to the rent income, but they still represent a significant, high-margin revenue stream that flows directly to the corporate entity. But what about the actual burger selling? Does McDonald's completely avoid the food business? Not entirely. McDonald's still directly owns and operates a small percentage of its restaurants, about 5% globally. These are its company-operated restaurants. In 2022, these locations generated $9.05 billion in revenue. So, yes, McDonald's does make money from selling Big Macs and fries directly, but it's a much smaller piece of the pie and, crucially, a far less profitable one. These company-operated stores serve a different strategic purpose. They act as testing grounds for new menu items, new operational procedures, and new technologies. They're laboratories for innovation, training centers for future franchisees, and showcases for the brand. They bear the full brunt of operational costs from ingredients to labor, which is why their operating margins are so much lower. They are vital for the brand's evolution, but they are not the primary engine of its wealth. The real money, the truly stable and scalable income, comes from being the landlord. This dual structure, a real estate giant disguised as a burger chain, supported by traditional franchise fees and a small, strategic fleet of company-operated stores, is what makes McDonald's so uniquely resilient. But the true genius of this model isn't just in what they own, but in how they leverage it. But the genius of McDonald's isn't just in owning real estate. It's the leverage this gives them over their franchisees. Think about it. When a franchisee signs that lease, they're not just renting a piece of land or a building. They're signing up for a relationship where McDonald's holds an immense amount of power. This control manifests in countless ways. McDonald's dictates everything from the menu items you can sell, to the precise layout of the kitchen, to the color scheme of the dining room, right down to the specific suppliers you must use for napkins and straws. Franchisees are locked into long-term leases, often 20 years, with escalating rent clauses. This means they're deeply invested, both financially and operationally, in the McDonald's system. They can't just pick up and move if they disagree with a corporate directive or if a new competitor opens next door. McDonald's owns the ground beneath their feet, literally. This model also masterfully transfers operational risk. Who worries about rising labor costs, fluctuating beef prices, or a sudden dip in local customer traffic? The franchisee, they bear the day-to-day headaches and the direct financial impact of running a restaurant. McDonald's, meanwhile, collects stable, predictable rent checks, largely insulated from these volatile factors. It's a brilliant maneuver. They get the brand presence, the market penetration, and the consistent revenue stream, while pushing the most labor-intensive and financially risky aspects of the business onto thousands of individual entrepreneurs. And expansion? This model allows for rapid, capital-efficient growth on a global scale. McDonald's doesn't need to tie up billions of dollars in building and operating every single restaurant. Instead, franchisees fund the upfront investment for construction, equipment, and initial operations. McDonald's provides the brand, the system, and, crucially, the prime real estate. It's a symbiotic yet highly asymmetric relationship that has allowed McDonald's to become the ubiquitous presence it is today, with 40,275 restaurants worldwide as of December 31st, 2022. This strategic brilliance also means McDonald's has a natural hedge against inflation. Real estate values tend to appreciate over time, and rent clauses often include inflationary adjustments. So, as the cost of living and doing business rises, so too does McDonald's revenue from its property holdings. It's a self-reinforcing cycle of wealth creation.
This unique hybrid model sets McDonald's apart from nearly all its competitors, positioning it more like a diversified real estate investment trust, a REIT, than a pure restaurant chain. Consider the alternatives. Take Subway or Domino's, for instance. Their models are primarily based on franchise fees and royalties. They are truly food businesses that leverage franchising for expansion. They own minimal real estate, and their revenue is directly tied to the sales performance of their franchisees. If a Subway struggles, Subway corporate feels it directly in reduced royalty payments. Then there are chains like Starbucks or Chipotle. These are predominantly company-owned and operated. They bear all the operational risks and reap all the rewards directly. They control every aspect, but they also shoulder every cost, from employee wages and benefits to utility bills and property taxes. Their profitability is directly exposed to the highly competitive and often thin-margined restaurant industry. McDonald's, however, occupies a different category entirely. With approximately 94.8% of its restaurants franchised, and owning roughly 45% of the land and 70% of the buildings for those locations, it has created a financial fortress. The operating margin for its franchised restaurants in 2022 was an astonishing 81.7%. Compare that to its company-operated restaurants, which had an operating margin of just 16.6%. That stark difference tells you everything you need to know about where the real profitability lies. It's not in the burger flipping. It's in the landlording. This model gives McDonald's unparalleled stability and profitability. While other chains might see their fortunes fluctuate with food trends or economic downturns, McDonald's has a bedrock of consistent, high-margin rental income. This financial strength allows it to weather storms, invest in innovation, and consistently return value to shareholders, having increased its dividend for 47 consecutive years, earning it the rare title of a dividend king. McDonald's isn't just a lesson in franchising, it's a masterclass in asset leverage and strategic diversification. It teaches us that the most successful businesses often aren't what they appear to be on the surface. They identify a core, high-value asset, in this case, prime real estate, and build an entire system around monetizing it, pushing operational risk onto others. It's a stark reminder that in modern capitalism, true wealth and power often lie not in the product you sell, but in the underlying infrastructure and control you command. Ray Kroc didn't just sell burgers, he sold locations. He didn't just build a restaurant chain, he built a real estate empire, cleverly disguised by golden arches and a friendly clown. Understanding this fundamental truth about McDonald's isn't just an interesting business anecdote. It's a powerful lens through which to